Hello and welcome. You're tuned into Business Today. I'm Sakshi Batra, and joining in on this show, I have a very, very special guest. Gurmeet Chadha, co-founder, Complete Circle Investments, joins right in. And he's here to share everything that you as investors must take note of right at the beginning of the new financial year. Welcome, Gurmeet, and Happy New Year to you. And thank you so much for speaking to us on day one of this new year.
Sakshi, good to connect, and wishing you a good, new, healthy, wealthy new financial year.
Thank you so much. So let's talk about financial New Year's resolutions. And you started off this day by tweeting those as well. Could you reiterate the three key resolutions that you think investors must definitely take today?
A few of them. I think some of the new investors have got used to very high abnormal returns in market. I think so. You should start the year thinking that some of these returns are not sustainable. Market gave a glimpse of it in last few months, especially pockets which were overheated. So
yes,
it's like a bit of a learning for newcomers. So keep modest expectations. Do not go for social media tips, WhatsApp tips, do detailed financial planning. The platform should be used to learn and network. Secondly, as I said, no amount is small and it's never too late. Thirdly, keep it simple and boring. I think the more this is back-ended, more is this boring, more it is less exciting, more it is rewarding.
Okay, so keep it simple and keep it boring, and boring is perhaps best for investors to keep. So that is what we are going to be following. But you said keep modest expectations for this year. Of course, the last 2 years have been very, very good in terms of the bull run continuing right after the 2020 crash. 70% exceptional year returns for FY21, then 19% for the last financial year. But will we be at least lucky, third year lucky for investors, even if it is modest expectations on the return front?
Yeah, so I'm not trying to scare anyone that returns won't be good. It's just that if you see last 6 months, Sakshi, as you pointed out, Nifty is flat, right? While the 1 year return, you're right, it's pretty heavy. Last 6 month returns are flat, and the market, despite index being 17,500 on Nifty, we've seen very, very healthy correction in few pockets. We've seen that in banks. We've seen that in some of the pharma API names. We have seen a big correction in the new age listings and companies. So market is rewarding good performance. It's punishing overvaluation and not so good performance. So my view is that this is a year of differentiation and consolidation. In every sector, you will see market differentiating companies. This is how good they are in handling inflation, commodity costs. How do they manage inventory? How do they manage supply shocks? Do they have the pricing power to pass on some of those hikes without affecting volume? And you'll see that in every sector. So this probably year is going to be a bottoms up year. And what by moderate expectations I mean is that it's the starting point, because then you don't take disproportionate risk, and that's when returns follow. And it could be a little back-ended for the year because returns in equity can be lumpy.
Right. But does the recent news of bond yields inverting, indicating at some point of a recession in the global markets, worry you at all? Is that going to be something that investors should keep track of and be very, very cautious about?
Yeah, partially. I think one should not overread into it because you don't know how the yield curve would be. The bond market obviously is a little more rational than equity market. And in the past, maybe 7 out of 10 times, it has rightly pointed towards a slowdown. But I think the bigger issue is interest rates going up globally and inflation catching up, which means your discounting rate also goes up. So when there's zero interest rate, I know stocks can command very high P's, but when the interest rate goes up, the discounting rate comes down. And that's why I said don't overpay. Just because something is fashionable, something is discussed too much, there's too much, hype around it. I think that's when So don't overpay. I think the best hedge for investor right now is good earnings growth. If you stick to companies who are reporting decent earnings, despite all the headwinds, geopolitical issues, bond yields going up, I think eventually you'll be rewarded.
Yeah, absolutely. Don't overpay. I think that's the key word that all the investors must definitely take note of. Of course, there was a wave in FY21 and 22 when we saw everything moving up and you were still making money at even higher valuations, but not always. So I think don't overpay is a very, very important word and advice that you're giving to all the investors right here. But for first-time investors, I still want to ask you, or those who are still contemplating about starting to invest in this new financial year. Now, there are some of those who say that I still don't get the complicated world of markets. It's too difficult for me to understand it. But they've actually come to realize that, yes, markets definitely give me better returns, better hedge against inflation, and are better than FDs or any of the debt forms as well. So how do I take that first step? What do you suggest?
So I think for first-time investors, I think SIP is a great tool. If you don't know anything, you can just SIP the index. I actually mentioned this a lot of times. If you take 31st March as the deadline, last 3-year return is 15%, last 5-year return is 15%, last 10-year return is 14%. Nifty since inception is 13-14%. So if you don't understand anything, just SIP the index. I think that should take care of you. You are a little more evolved customer. You track markets closely. You love analyzing balance sheets, reading reports. Then you can nibble into direct stocks and other products. And as I said, research well, do your homework well. And if you do that, eventually you'll be good, because there are some themes which, Sakshi, I think are more secular in nature. A lot of these, negative events won't be there 3 months, 6 months down the line, but these themes would still be around as part of the overall investor.
Absolutely. I will speak about those themes and sectors. We will go into those details as well for all our viewers. But just like how you said that, perhaps index funds is an easier way for those investors to start off with, because even if we look at the past 2-year returns, the markets have given up very, very handsomely, if you've not created that alpha, but at least you're getting that 18-19% as well. So help me understand, is index fund going to be still the right choice for somebody who's absolutely new in this new year as well?
Oh, absolutely. I think, and if you see that most of the portfolio managers, active ones, are also struggling, not in India, but globally to, beat the benchmark, right? And, but, only thing is the time horizon has to be long, because, while average return has been 14% for last 20 years, there's been only 3 or 4 years where the return has been close to 14.
Yeah.
So either you see a 20%, 25% kind of a year, or you see a very subdued year, right? So you can have 2 bad years in 5 years, right? But you can still make double-digit returns. So I think, and that's why I said, SIP works well, because it helps you to average. We call this concept at rupee cost averaging. So have a time horizon, just bucket it. You should have your goals clearly bucketed. So one which are high priority, medium-term goals, don't take too much risk. You can do a combination of safer instruments. Let's say you want to buy a house 3 years from now, or you want to, plan an education which is nearby. There you should not take too much risk and get carried away. But if you have high priority long-term goals, your retirement, or if your children are young, maybe they're married, then I think equity, index funds, direct stocks, right combination is a good choice.
Absolutely, you're right there. Now, you pointed about several concerns and macro headwinds that the markets are facing. Of course, the inflationary pressures, the interest rate hike issue, the lower economic growth that we are looking at, the higher input costs. Now, despite all of this, which are the themes and the sectors that you're very, very bullish on, despite all of these concerns?
So, we did one analysis that, as I said, last 20 years, there have been 18 years market has corrected 10%. There has been 1 in every 2 years, there has been a 20% correction, Sakshi. And every 5-7 years, there's a large correction, right? The names can change. It could be COVID, it can be Lehman crisis, it can be anything. So I think that's integral to investing. So I think this will continue. We'll probably have another wall of worry, 6 months down the line, could be something else, right? But 3-4 things are clearly standing out. One is the digital transformation of India. I think what we are seeing is something which is unprecedented.
Yes.
I don't want to be insensitive in saying this, but I think COVID also played a role in triggering so we were already undertaking digital transformation. I think COVID expedited it. So if you get time, if you hear the commentary of large IT companies, whenever you're free, just log in into, previous earning call or the current earning call, which will come in April, see the nature of deals which are happening. So if you rewind yourself 5 years back, you will see IT companies doing certification deals, accreditation deals. Now you're suddenly seeing transformation deals. There are partnerships being formed. There are co-innovation centers being developed. So these are more outcome driven. And that is why for all the wage hikes and supply challenges, they're reporting good numbers. Look at, for example, Infosys. When did you last see 20% guidance? Right. So you are seeing, you are probably in a, early to mid stage of digital transformation.
Yes.
Look at companies like L&T Infotech, Mindtree, Tata Elxsi. This is last 5 years, the IT index of BSE. If you see BSE IT index, the return is 28%.
Yeah.
So it's so I think now, again, don't pay again 50-60 P multiples of the IT names. So if you are steady here, I think this will do well. Also, a lot of companies traditionally are undertaking it. So I also call, a CDSL a fintech company, because everything is happening online. We are opening
Absolutely.
online accounts. There are gas exchanges, energy exchanges getting developed. So that's one thing which I think is more long term, and I think we are probably in early to mid stage of it. The second theme is this, PLI induced manufacturing uptick. I will not call it a capex cycle. We are in early days right now. But if we are able to sustain this global commodity pressure well, and hopefully get things right, we are probably at the very cusp of a new investment cycle. And yesterday there was a manufacturing forum. It was a 2-day manufacturing forum. You had people from all industries, and look at the way EMS and original design manufacturing is happening in India. Look at our solar module policy of PLI. Look at our API policy for pharma, look at semiconductor policy. So I think that's the second theme where we are seeing, manufacturing getting, it is PLI led, it is import substitution led, it is China plus one opportunity. It's a combination of, all these factors. That's the second one, which I think is more long term, because when you do capex, you're not thinking of 6 months, 12 months. You really, as an entrepreneur, I'm looking at maybe 5 years, 7 years, 10 years, right? And the third one is why we are doing this, right? There's so much of interest in equity, right? Despite all of this, our equity penetration is 5%. So largely, and I think we are opening 1 lakh Demat accounts now for almost a year. 75% of these Demat accounts are of people below 75 years of age. So that makes me very excited. And Sakshi, when did you last saw $20 billion of selling by FIs and markets?
Absolutely. And still resilient markets.
So I'm not saying we didn't fall, but I think a large part of the damage was cushioned off thanks to, this equity culture.
Constant DIS.
So you can play it through private banks, you can play it through depositories, asset management companies, insurance. So I think these 3 themes predominantly, to me, there are more obviously sub themes, are something which will, I think, stand out in the medium term.
Right. You very, very importantly said that, SIP is the right way. But SIPs, usually all the first time investors understand is that you only have the mutual fund route as well. But for those, like you said, that who can do their research, they can also start a SIPs in some specific stocks. You create a basket of your portfolio and start a regular way of investing in it. So if one has to start that portfolio of stocks today, what would be your key picks where one can actually start off by investing in? It's all about stocks, and that's what investors want to know.
So I will tell you what personally I do stock SIPs. I think this entire debate of this versus that is overrated. You should figure out a right combination. So it is not that SIP in mutual fund is bad, SIP in stocks is good. SIP in stocks can be more rewarding, but can be more risky because you're, end of the day, holding very concentrated portfolio. Again, taking advantage of these 3 themes, which we discussed in digitization. So I'll tell you what personally I do stock SIP. And I do in IT, I do Infosys, TCS. In manufacturing and PLI and investment cycle playing out, I do a combination of API names like DBs, PI Industries, companies which are getting into solar modules and renewable energy like Reliance, Tata Power. So this is my you can call it energy stroke PLI stroke manufacturing portfolio. Then I have some couple of, and I'm a banker, so that old love for banks doesn't go away. So there's HDFC, there is ICICI Bank, and then there are insurance names. There is CDSL depository. So I play that, and I'm also extremely positive on this home improvement theme. What I'm seeing is affordability going up. And people wanting bigger space, their own space. I think that obviously is also a bit of COVID-led. So some good names in paints, in pipes, in cables and wires like Polycab, in paints like Asian Paints can be looked at. And the last one is home consumption. I think all of things around in our kitchen shelf will get branded. So what has happened to a tea, coffee, atta will happen to pulses and spices and almost everything, right? So maybe Tata Consumer there.
But nothing of the realty space. You're not consuming it directly, all indirect fashion. I mean, despite the kind of move that we've seen here, you're still a little cautious on that space. Is that?
See, you got to have a little more advanced knowledge. I don't think so. Reality is an SIP theme to play. If you have great knowledge, there was just cyclical. If you remember last time real estate stocks were up was in 2007, right?
Yeah.
Now the cycle has come after 12, 13 years. So as a retail investor, it can be tricky. You can play that as a home improvement theme, right? So if real estate is picking up, and real estate has 40 different sectors attached to it, right? Sanitary ware, tile makers, electronics, and everything. So I think that's a bet. And plus the balance sheet is less leveraged. Real estate also has a lot of debt, right? Which can be a little tricky.
Absolutely. Well, thank you so much, Gurmeet, for speaking to us and sharing all these wonderful insights. I'm sure that all the viewers have actually taken note of all that portfolio stocks, because those are going to be key for them to start off with today. And I hope that you have a great financial year ahead, and I'll catch you very, very soon on Business Today yet again. Thank you so much.
Thank you. Happy investing.
Thank you so much, sir.